With this strategy, all you need to do is just to mark out 3 things and you take your trade. This is the only day trading strategy you are going to ever need. This was last 2 weeks opportunity I had, and this was a sell I took which hit full take profit. This was another buy I took right here, and this buy hit full take profit. And this was a sell I tried taking. This sell went against me, did not go well. This was a buy I took, and this buy hit full take profit. And last 2 weeks I had about 9 opportunity, 9 trades in total, of which 5 of those trades hit full take profit with a minimum of 4 arrow on each trade, and I hit about 3 stop loss, and I had 1 missed opportunity. That was last 2 weeks. And this very week that just ended now, I had about 6 opportunity, of which 2 hits take profit and about 1 of the trade hits stop loss, and I ended the week with 6 arrow. In this very video, I'm going to teach you this very strategy, and it's going to be the only strategy you're going to need. It's simple, it's straightforward, and it's easy to use, and you can use it to trade any currency pair, any commodity, any stock you trade. So I'm not going to waste time. Let me begin. The whole concept of this very strategy is revolving around just 3 things. The first one is the break of structure, which is going to help you know the trend, if you should be buying or you should be selling. Then the second thing is liquidity, which helps fuel the move. Then the final thing is the point of entry, where you will now execute your trade, where you will not take the buy or take the sell from. Now, the whole idea of this very strategy is first break of structure. And if you don't know what a break of structure is a break above a previous high or a break below a previous low. Now, let's say this is a high the price created, and the price came back up to break above that high. Breaking past that high now is a break of structure, and this break of structure now is a break to the upside, showing that this market is going up. Now, if the price have a low, the price goes up, then come down, break below that low. That's a break of structure to the downside, showing that this market is going down. And if you watch, if the market is going down now, I'm meant to start looking out for sales. Then if the market is going up, that's breaking structure to the upside, I'm meant to start looking out for buys. Now, if you watch this very market closely, it had this low, then went up. On coming back, it broke past this very low as a break of structure to the downside. And if you watch, this is another low the price created, then it went up. On coming down, it broke past that very low. That's another break of structure to the downside, showing you that this market is going down. This market is bearish, right? Which the different type of market we have. This market is bearish, and on this very market, you don't start looking out for buys, but instead you should be looking out to sell. Now, that's one thing with this very strategy. The second one is liquidity. Liquidity now is going to help you validate where you'll be taking the trade from. And you know, institutional traders, they need liquidity to get involved with the market. They need liquidity to get into the market. And I believe you guys watching me already know about these institutional traders, right? They're the ones who move the market. They're the ones who push the price up or push the price down. And for them to get involved, they're going to need enough liquidity to enter the market. And liquidity now is always from stop losses, from stop orders. Once you have your stop loss and you get stopped out, you are losing money to the market. That money you are losing now is the liquidity you are giving to the market. And once traders are being stopped out, there's going to be enough liquidity for these institutional traders to get involved in the market. So liquidity, what I use is just lows and highs. Once I have a low or I have a high, there's liquidity above that high or below that low, of which that's all liquidity is. There's liquidity below every low in the market. Some traders are going to tell you Asia high, London high, New York high. As for me, every single high in the market, every single low the price creates has liquidity, because traders are going to likely take their sell from that high or take their buy from that low and then place their stop loss below that low or above that high. What I do is I now mark out my point of entry, which is the third thing with this very strategy. The third thing is the point of entry, where you will now enter your trade. And this point of entry now are always the demand zones and the supply zones. And what I use right there, they are order blocks. I mark out order blocks as those zones. And don't get confused, this is what order block is. Order block is just your last opposite candle before a bullish or a bearish move. Now, watch this. Price was going down at this point. On getting here, it formed this last black candle, then it started going up. On going up now, the candle it was forming were more of bullish candle, which are blues. My chart is blue, so your chart now might be red and green. So it's doing more of blue candle to the upside. So clearly, this last bearish candle it created now is the order block. So I can mark it out, indicate it as an order block, and you can see that's where the price came back to and started buying. I'm going to explain everything. Now, that's an order block. In a case where it's for a sell, price goes up, get to that point, and then start going down. That last bullish candle before it started going down, that's the order block. That's now my point of entry. And how do I enter trade from these very levels? Now, before I give you how you enter trade from this very level, long wicks can also act as your order block. When you have scenarios where you have just long wick, those long wick now can as well act as an order block. So in this case, we have this long wick. This wick is not small, it's a long wick. I can mark out only the wick as an order block. And if you watch, that's where the price came to and dropped. Now, in a scenario where there's no wick, of which the last bearish candle before the bullish move, or the last bullish candle before the bearish move, is the order block. But in a scenario where there's a long wick, not tiny wicks, you can as well use a long wick as your order block. And this is your order block now, that your point of entry where you'll be taking the trade from. Now, how do we now take trade from this? We want to look out for everything complete, and in this case now, everything right here is complete. Right? If you watch closely, price had this low, it came down, went up, broke past that very low. That's a break of structure to the downside, and now showing me that this market is bearish. Even if you are not able to validate that that market is bearish using that first break of structure, you're going to notice we have another low right here, of which the price broke this other low to the downside, showing that okay, this market is actually now bearish, meaning I'm actually now gonna start looking out for sales. Now, if you watch closely, this long wick now acted as my order block, and if you watch, this high acted as my liquidity, of which I told you every high is liquidity. This can be London high, this can be Asia high, this can be New York high. As far as it's a high, I just mark it out as my liquidity. It's a form of inducement, a trap which traders are going to fall for, because traders will likely sell from here because it's like a supply zone. It's an order block on its own, right? So it's an inducement, it's a trap, it's a supply zone, a resistance zone which traders will likely sell from, an order block, a point of entry. So if traders sell from here, they will likely get stopped out before the price will actually now go my way. So if they sell from there now, they will actually get stopped out, and once they get stopped out now, they have been induced, they've provided liquidity into the market, and now my trade can now move. And what do? Once I have everything marked out, we take our trade, right? With the strategy, I take my entry from the very beginning of the order block, which this is a short position too. I pick it, then I place it from the very beginning of the order block. Then I'm going to have my stop loss above the order block, not too tight, right, and not too large, just slightly above it, because if the price will respect this order block, it won't break above it before going down. So this is how I take my trade. Stop loss above it, entry at the very beginning of the order block. Then I can target this nearest low as my expected break of structure, because that is now a low. I expect price to break to continue going down. Now, let me show you multiple scenarios where that happens. First, I want to see all my criteria complete, which are my break of structure. And if you watch, price at this very low, it broke past it. That's a break of structure to the downside. So I can indicate it just to know my trend, just to know what I will be doing. If you watch, this is a high, price did not break that high, but it had a low, it broke that low. It had another high, it didn't break that high, but it had a low, it broke that low, showing that okay, this market is bearish. I'm meant to look out for sell. If it was bullish, in this scenario now it's bullish. This is a high, and what happened? Price broke that high, right? This is another high. What happened? Price broke that high. This is a low, and price never came down to break that low, right? And if you watch another low right here, price never came down to break that low, showing that this market is bullish. You look out for buys. But in a scenario where it was breaking to the downside, you look out for sales. In this case now, this is my break of structure, which is the three things I need with the strategy. Break of structure, then this last bullish candle before the price started dropping is my order block. I can indicate it and then mark it out. The only thing that was not present right here is the liquidity, of which liquidity is just going to fuel the move. It's just going to help institutional traders get involved in the market. If there's no liquidity, the price can as well move, meaning there's already liquidity in the market. the price can move. International traders can get involved and the price will move. But just to make you feel more confident and give you extra confidence, you need your break of structure. You need your liquidity present on the chart. Now, if you want this is a low, I can set my take profit and expect the price to get there. What happened? These two things were complete. Break of structure, order block, which is my point of entry. I take my sell, which break of structure shows me that this market is going down. Order block shows me that this is where international traders will likely get involved, and this is where I should get involved as well. Then the only thing now is the liquidity. There was no clear liquidity present right here. There was no clear high. The price needs to take out. And let me show you multiple examples with this very strategy. And remember, this is a day trading strategy. You can use it every single day. You can go to your chart every single day and do similar thing, right? And since you are a day trader, since it's a day trading strategy, you can use from your 30 minutes time frame, 1 hour time frame, 15 minutes time frame, and a 5 minutes time frame. You can use between those time frame, right? Your 1 hour, 30 minutes, 15 minutes, and 5 minutes. You can pick to use any of the time frame. I personally love using 30 minutes and a 15 minutes time frame. So you can just go to those time frame and then mark them out and then start jumping on your trades, start taking your trades. Now, just look out for opportunity. And as you already know, strategy does not work 100% of the time. At some point, this strategy will not go as you are expecting every single time. But it's important you understand everything regarding this strategy. And I'm going to advise you, go through my YouTube video. I've done a couple of videos about this very strategy. So go to those YouTube videos, understand how the strategy is, understand some things about the strategy in determining your trend, in determining everything regarding this very strategy before you go to your chart and start applying it. So this is a simple strategy. This is a day trading strategy. And if you watch multiple opportunity I had last week, multiple opportunity I had this week, multiple opportunity I had last 2 weeks, I had more wins than losses. So it's a good strategy. It's a strategy that can make you profitable. It's a strategy that keeps giving me good risk to reward ratio, good win rate, good trade opportunity every single day. So I'm a day trader, and this strategy is helping me becoming profitable, and this is also going to help you become profitable, right? So if this video was helpful, don't forget, like the video, subscribe, and if it's your first time here, turn on the notification bell, and I'll see you guys in the next video.